Welcome, everybody. Over the past few weeks, we've been spending a lot of time looking at banking and money policy in Canada today. In particular, we've looked at a couple of important themes. Over the past few days, we've looked a little bit at the idea of a central bank like the Bank of Canada. We've talked about what they are, why they're established. We've also talked about how the particular central bank that we have in Canada, the Bank of Canada, how it operates, what its key functions are, and we talked a little bit about the appointment process by which it chooses its head, who for the last 7 years has been Stefan Poloz, and who we recently learned within the past couple of weeks will be starting in June, Tiff Macklem. We've also spent a little bit of time talking about something called the money multiplier effect. And in particular, what we've seen is that while banks play important roles in terms of guiding people's investments and providing safe storage locations for their money, they're also really, really important to the overall foundations of the economy because in creating loans, using deposits that have put into their system, they actually create a lot more money within the economy, and they create what we call this money multiplier effect. Finally, today, what we're going to start to look at is a lesson or two which will start to put together both the idea of the Bank of Canada as a regulator and the concept of the money multiplier effect. And we're going to look at how the Bank of Canada uses its ability to regulate money to create either more money multiplication or less money multiplication in a process which we commonly refer to as monetary policy. Monetary policy is a pretty important issue. We're going to talk about it for about a week or so in our grade 12 economics course. Please understand, though, that if you do go on and you do study economics at a future date, you are going to run into this quite a bit. The parameters may change slightly. So, for example, some of the specifics that we're looking at are, of course, the Canadian focus. We'll talk about specifics of the Bank of Canada and its policies and what it's currently doing. You may find slightly different tools and approaches in other countries with other central banks. But the general idea of a central bank trying to guide the economy forward in conjunction with a government, that's really crucial to the foundations of macroeconomics. And on that basis, I would recommend really paying careful attention to this lesson because it's a very, very important one. All right. So, looking back a little bit, we understand that today's economists typically accept that government has some role to play in an economy. There's a debate about just how much. A more classical minded economist might argue that laissez faire has its advantages and that too much government represents potential imbalances within the economy. There may be a little bit too much self interest, and there may be a lot of risks in terms of things like that. Others, who are a little bit more perhaps left leaning in terms of their views, may actually argue that the government doesn't get involved as much as it should, and that the more regulation the government can provide, the better. And then, of course, there's people in the middle. Most people, however, do agree that while we have a self regulating system of the business cycle that exists in any capitalist type economy, there is an opportunity for a government to get involved. And in fact, particularly when you hit the highest peaks and when you hit the highest troughs in terms of the ups and downs of that cycle, there is actually a moment where government should really step in and try to smooth that cycle out a little. We've looked at Keynesian models of fiscal policy, and we've seen that one of the ways that the government can actually manage the economy is by using its tool sets of spending and taxation in order to either inject life into a failing economy by stimulating, creating new government spending, reducing taxes to create new incentives for growth. It can also, if it chooses to, work the reverse way. And it can take life out of an economy that maybe is going a little bit too quickly by raising taxes and perhaps reducing the expenditures. What we're going to look at a little bit today is an extension of that interventionary process for a government, but we're going to be looking at how the bank also plays a role, and in particular, the central bank. You're going to see that the central bank uses what it calls monetary policy to do similar kinds of things, to push the economy up when it's in trouble, to slow the economy down when it's doing quite well. It's actually a very useful tool because, unlike fiscal policy, which, while democratic, tends to be quite slow and sometimes cumbersome, it takes a long time to get the money flows moving. Monetary policy is actually quite the reverse. It's not quite as democratic, which has its pros and its cons, but it is, based on the way it functions, quite rapid. And certainly in cases where you need immediate action, or perhaps you just need small incremental changes and you want to fine tune the economy with quick and immediate micro responses to micro problems, then monetary policy is actually often quite ideal. Okay, so how does monetary policy work? Well, to do that and to explain that, we do have to take a little bit of a step back and just talk about the overall concept of the money supply and how it tends to grow and contract over time. One thing that's worth noting is that even before we start looking at monetary policy, when you look at an economy, money doesn't just stay static. Rather, the money supply will actually grow and contract automatically. And even if there was no central bank, you would see more money in certain periods of time and less in others. Why? Well, there's a few reasons for this. First of all, money tends to naturally grow when the economy is doing well. When the economy is doing well, people will often have lots of spending. They may be more willing to take loans for things that they feel are necessary expenditures. Businesses may want to take more chances. And so, as that happens, that expansion of credit, that expansion of spending will naturally tend to lead to more overall money within the system. Similarly, if for reasons where perhaps there's more negativity creeping into the economy, people decide to spend less, then as that happens, the money supply will contract. Banks may decide to become a little bit more hesitant to give out loans. They may become a little bit more concerned. And as that starts to occur, and as the desire and the demand for those loans in a bad economy contracts, then eventually the money supply will start to shrink on itself. It's also worth noting that these movements, growth and contraction, tend to self regulate. We don't just see unlimited growth within the economy, and we certainly don't just see unlimited contraction. But in fact, if you allowed for laissez faire to take hold and if you allowed the economy to guide itself, the economy would tend to see upwards and downward cycles that would each tend to eventually create the momentum to reverse and replace with the opposite policy. Uh, to give you an example how this might work, we'll start with the idea of too much growth. Growth will tend to lead to an amount of money increasing over time. More loans, more demand for those loans, there will be more money. But eventually, if you have enough people spending and enough people competing for loans, you may actually see the process itself start to put a cap on that growth or that momentum because the increased demand for loans will cause for higher interest rates as there's just not enough credit to go around. The higher interest rates may make people think twice about spending money, and slowly but surely, as they start to become the norm, the growth of the money will start to eventually slow and then perhaps actually move towards a reverse direction. Similarly, if you have an economy in slowdown, well, when you have that low demand, while it at first may lead to actually a contraction of the money supply, banks may get nervous, people may become wary of taking out loans. What will eventually happen is that as prices and as overall spending starts to decrease, some people will see opportunities. Some people will want to actually start to take advantage of interest rates that, with that low demand, actually happen to be quite low. And then eventually, as they start to take those chances, while it might take time, they will start to, in doing so, increase the demand for money, increase the amount of money moving around, and so on and so forth. So these things will happen naturally, and there's a natural self regulation that occurs. Why then would the Bank of Canada want to get involved? Well, it's no different than why a government might want to get involved in the economy in terms of its fiscal initiatives. The Bank of Canada could just stand back and let the market take its course. It would correct itself, but we live in a real world with real people, and it may mean that sometimes those cycles are just a little bit too slow for comfort. There may be just a little bit too much depth to the troughs in terms of the decline in bad times, and there may be a situation where the government feels like it actually has to, or would be beneficial for them to not only step in, but also encourage its central bank to take similar sorts of measures. Thus, because the Bank of Canada has many key power levers and policy tools at its disposal, it actually can actively try to intervene and either speed up money creation or slow down maybe too much money moving around. And when it actively and intentionally does so, those active and intentional policies designed to push the economy in a direction that it wasn't either already going, or maybe push it further in a direction it was going, those intentional moves are actually representative of an intentional or monetary policy. And defined monetary policy, to reiterate, is when the central bank alters the economy by directly and intentionally, with purpose, altering the supply in a nation. There's generally two major types of monetary policy that exist at a broad level, and they're pretty straightforward just in terms of terms and what they represent. The first one is what we would call an expansionary monetary policy, or more commonly, what we'd call easy money. And the name itself tends to give away what it actually represents. Usually, this is done to inject life into an economy by boosting the money supply, and it would typically be done in a period of recession where there just wasn't enough money moving around. As you're going to see, in the next couple of minutes, there's a lot of ways that you can use an easy money policy. The most common of all, though, involves lowering interest rates in order to make credit more available and to get more money flowing through the multiplier effect. The other type of policy is the opposite, a contractionary. This would be a policy called tight money, which you would tend to use when you have too much growth. It is actually often used by the government and in particular, of course, the Bank of Canada, who has an independence to a certain extent to make these choices. It's often used in situations where you do have booms. It's usually less unpopular than contractionary fiscal policy. It's a little bit easier and quicker to implement, and it's also easier to turn off in case it goes too far. And so, oftentimes, when you see a boom within the economy, tight money policy in terms of higher interest rates, it may get introduced because the goal is to try to reduce that growth, but not necessarily completely counteract it. Of course, some growth in the economy is always a good thing. Now, how does monetary policy work specifically? Well, the goal is to either increase or decrease the amount of money. But there's a number of ways that you can actually, as a bank, achieve this. And while I'm only listing a few of those, four that stand out are going to be the tools that we're going to look at in the next few minutes. The first tool involves actually trying to change the amount of money through direct, intentional intervention in the money system. And we call that changing the monetary base, or more particularly, a term that's often used is OMO, or open market operations. Okay, recall it's just OMO, no consonant in the front. In terms of open market operations, the way these work are as follows. The Bank of Canada will actively try to either flood the market with money if it wants there to be more, or reduce the amount of money in the market if it wants there to be less. If it wants there to be more cash and liquid money in the economy, it will take things that it has in its reserves, things like, for example, bonds, or things like, for example, foreign exchange. And what it will do is it will offer those up to the public, or at least it will offer to buy them from the public. If the public sells those opportunities to the bank, or those particular assets, sorry, I'm saying that very unclearly, but if it buys those assets from the public, then what will happen in that particular case is that by buying those assets, the bank will trade its cash. It will flood the market with new liquid cash, and thus you will have more money in circulation. Whereas if the Bank of Canada wanted to have a little bit more of a tight money policy and take out some of the money that's moving around, maybe it feels like the economy is moving too quickly, it may actually offer to sell its non-liquid assets. Now, why would that decrease the amount of money in the economy? Well, if it sells to a private citizen a bond, or if it sells foreign exchange, it takes Canadian cash, which is very liquid, out of the market, exchanges it for something that's not quite money, and thus the amount of physical liquid money in the economy will reduce. Okay, so open market operations are direct and intentional ways of trying to alter the amount of money. A second policy that the Bank of Canada can use when it's trying to enact monetary policy is changing the reserve requirements. This is a policy tool that makes sense in theory, in practice may not be as common. But essentially the idea is this. If you want banks to loan more money, then put less restrictions on them. And so the Bank of Canada may say, well, instead of having to have 10% of your money on reserve, then you only have to have 5. And so long as the bank, the chartered bank, decides to take that extra risk that's now available to them, then in only having to hold on to 5% of their money, they'll actually have double the multiplier effect. Practically speaking, does the Bank of Canada regularly change reserve requirements? Not really. And part of the reason why is that in Canada, most 95% of the assets in the banking system are controlled by 5 to 7 very large banks that probably aren't going to rapidly take chances, even if they have the opportunity to do so. And so even if you reduced or you have to reserve requirement, it doesn't guarantee that the bank would actually decide to double its loans. It may not quite be that risky in terms of its behavior, but what the bank may do is they may reduce other types of requirements. And so while they may not necessarily, the central bank, be changing the reserve requirement, because that doesn't always necessarily work as well as it should in theory, they may do other things to make it easier to give loans, which again will tend to create more or less money. So keep that in mind. It's a good theoretical answer for how you can change the money supply, but in practice, it's not a tool that's regularly used. And you wouldn't really want a Bank of Canada or a central bank all the time changing that reserve requirement, because again, that would introduce a lot of potential new risk to the economy that usually is not ideal. A third tool that you can use would be calling in or extending loans. The Bank of Canada is the banker to the chartered banks, and it gives a lot of money to those banks when they require it. If it wants to have less money in the economy, it can actually just go to those banks and either say, hey, it's going to be more difficult to get loans from us, we're going to make it a little bit more complicated, or B, they can actually ask for some of those loans that they've given out to be recalled and given back to them. Similarly, if they want there to be more money in the economy, then rather than recalling loans, they can actually make it easier to get a loan, and they can actually give more loans out. And so that's a way that they can actually actively encourage money to be created or decreased in the economy just by what they do with the central banks, or sorry, the chartered banks. And then finally, the last tool, it's the most common, most famous, is changing interest rates. Now, can the Bank of Canada tell private banks what interest to charge to customers? Of course not. A private interest rate is determined by many factors. What's the risk of the particular person involved? How much income do they have? What kind of loan are they taking? How long is the term of the loan? There's a million variables that help to determine why it is that certain people get higher rates than others do. And typically, risk is the defining feature of the specific rate that you're given when you get a loan. However, there is a general benchmark for how interest rates look. And in certain periods of time, interest rates tend to be down across the board. And in other periods of time, they tend to be a little bit higher. Because the Bank of Canada actually gives loan to chartered banks, they actually give their own interest rate to those banks, which is often one of the lower rates that you'd see within the economy today. They call that particular rate that the Bank of Canada offers to the chartered banks a bank rate. And while it doesn't directly determine the rates that individual consumers get when they take loans from their chartered banks, it does help to indicate a general goal or pattern or desire of the bank. And it tends to work in a domino like fashion. A low bank rate will often mean that private citizens are getting lower interest rate. Whereas if the Bank of Canada raises its benchmark overnight, or what they call bank rate, overnight rates, just another term for that, then as it raises that overnight rate, then the charter banks will often, in lockstep or in domino format, will start to raise their rates as well. Okay, and so when you see the bank rate, it often indicates just whether the Bank of Canada wants easier or tighter money policy based on circumstances. It's not always an easy thing for the Bank of Canada to get its ideas out there. Certainly, even though it's an appointed role, the governor of the Bank of Canada has to do a lot of work in Canada today, talking to the public and talking to investors and giving them an idea of not just what the bank policy is, but also giving them a little bit of an idea for exactly what they plan on doing in the future. And as we talked about in one of our lessons, typically speaking, they put those feelers out there well in advance of the actual decisions. They never just drop a decision on people, because that would be far too turbulent in terms of its impact on the market. Right now, the interest rate in Canada, or at least when I made this video, and I doubt it's changed, was 0.25%. That's actually been reduced by over 1% over the past 2 months. Why have they reduced that rate, and why have they put it almost as low as they can? Well, you can probably guess. We're in the middle of a very, very difficult situation. And even though we're not quite at an opportunity point where people are really taking a lot of loans and taking a lot of chances, because there's nothing really to spend that money on, and the bank knows that it's in a very difficult spot, the hope is that it certainly won't be discouraging loan taking or investment opportunities, and that when the economy starts to pick up, the lower interest rate will trigger hopefully some more expansionary money policy in the weeks to come. And here you can get an idea of the message that's coming. Clearly, the Bank of Canada is telling citizens, here's a low interest rate. We want you to spend some money. Now, one final thing that's worth noting, and then I'll finish up. Theoretically, the bank can do whatever it wants when it comes to deciding how to alter the money supply. In tough or difficult, unusual times like right now, they tend to throw out the rule book a little bit and just focus on the immediate emergency needs of the economy. When things are a little bit better, though, there is at least a guiding principle that determines whether easier or more tight money policy is required, and that is referred to as what we call inflation targeting. Essentially, what that means is that the Bank of Canada will look at the inflation rate within the country, and they'll try to, through their policies, keep it between 1% and 3%. 1% is enough to show at least moderate, stable growth. 3% would be starting to become risky because it would be putting too much inflationary pressures down. And so if you had a lower than 1% rate, that would be an indication the economy is kind of slow. The bank would use a more expansionary policy, lower interest rates, and do other things to encourage more money to flow through. Whereas if the interest, or sorry, not the interest, but the inflation rate within the economy were to rise above 3%, then the opposite would start to occur. The bank would see the higher than usual inflation as an indication of probably higher than usual spending, and in turn, it would start to raise interest rates, increase the tight money policies it's using in order to try to get the economy down a little bit. Okay, and you can see that there. The term again is inflation targeting, and that's just the graph of how it works. It's in your textbook if you want to read about it. It's not quite consistent with what we've been doing, at least in the current moment, because of course the emergency right now is so significant that it takes precedence over just general basic policy. But in a good time, this is generally the goal that the government is trying to seek out. All right, final point is just a summarization of monetary policy. And we're going to link it back to the aggregate demand, aggregate supply model that you saw about 3 or 4 weeks ago within the course. When you have an easy money policy, just to reiterate, you're using that to try to give your economy a boost. Typically, the goal is to try to lower interest rates and increase the amount of money that's there. You can also do that not just by lowering your overnight target interest rate, but also by transferring money from the central bank to charter banks, so making it easier for them to get loans, reducing restrictions, and then also, if you want to physically change the amount of money, offering to buy less liquid assets like bonds on the open market through open market operations, or OMO, in order to try to increase the liquidity of money and the amount of money that's there. When would you use an easy money policy? Well, we can show this here with this graph, and you'll have to apologize, or I'll have to apologize. My graph is not particularly ideal, but I'll do my best just to give you an example of this. You would be using these policies in a moment where you started with a recession. So if you look at your graph, you can see how that might work. We have an economy, and it's a little messy, but you can get an idea of it. That looks like that. There's your GDP. You have an AD curve, or AS, that looks like this. You want your AS to be here, but you're not at YFE yet. And in fact, in your position before you would use this particular policy, you are well below. And I'll show that with AD. This is so hard to do without a proper board there. That's YFE if you can't read that. You would show it like this. That would be your initial point. You're in a recession, and your goal would be through your policy to enact growth and to push your economy forward to here. Now, you may not get there all just using an easy money policy. In fact, as we're going to talk about in a couple of days, it'd probably be almost impossible, because you're not going to just encourage people in bad times to take massive amounts of loan to increase spending by that much. But that's, at least if you look at the policy direction, that's at least the goal or the target. When might we use tight money policies? Well, in the opposite situations, you would use those policies when there's too much growth and when you want to slow things down. Usually, you would do that by raising your interest rates via the target rate, reducing the amount of loans and making it harder for chartered banks to get loans, and then selling your less liquid assets on the open market in order to take cash off, because you'd be taking liquid cash and replacing it with things that don't move around as much in terms of their liquidity. When you draw your graph will look like this. So we can show it on the screen, and I can draw that in. And sorry, this is very, very messy, but you get the idea. You would start off with a situation like this one right here, where you have too much growth, and you would try to not push your economy into a recession, but just try to push it down, hopefully enough, so that you would still have fairly good growth, but that you would reduce the inflationary pressures that exist. And again, I'm not going to try and label this because my graph is already a messy nightmare, but you can get the general idea of where we're going with that particular policy. We're trying to push the economy backwards to at least a little bit more of a stable level, turn it down. I should mention that tight money policies are very popular with governments. They're popular because when you want to slow an economy down, you can fine tune it down a little bit, maybe raise the interest rates just a tad, which is very useful rather than fiscal policy, which may go too far. And it's also less politically difficult because you're not going to see the kind of opposition in society towards, oh, interest rates went up 1%, that you might if you saw a government saying, oh, well, we're going to cut back on XYZ forms or varieties of fiscal government spending. Okay, your homework for tonight is listed on the screen there. I'll talk a little bit more about the specifics of that with you in the next couple of days and listed on Edsby. But hopefully this made sense. And again, if you have any questions when we come back to class in a few days, please make sure to bring those up with me.